Gold at 5,000, silver over $100. We're going to be talking about the precious metals bull market. But first, a shout out to our sponsor, Fiscal AI. It's where Max and I get all of our fundamental equity data, where we do our equity research. You can get 15% off any paid tier with fiscal.ai/MM. Let's get into it. Max, great to see you. Good to be speaking with you again here.
Great to talk to you again, Jack, and to be talking about precious metals. We talk about it a lot. We dedicated some time, I think, back in October, specifically to silver. I know you brought out, I forget exactly which industry organization it was, but a great report on the physical shortage in silver. At least if you've been tracking the price, that seems to be playing out. It was quite the call from back in October. Are you still in the silver trade with us now over $100?
So the short answer is yes. I don't own any silver. I prefer to express this trade in a way that we will get into. My participation in the precious meta beta play, let's call it that way, is a little over a year old. So I'm not that early at all. And I certainly was not early in time, Max, when we talked about that in October. But just look at the price of silver. The price of silver in October, even though we weren't early at all, was $50, and now it's double that. I remember thinking at $50, this is getting a little too crazy. I mean, the price of silver has doubled from here, and yet it has doubled from there. Now, Max, I first want to share a few observations, which is number one, commodities tend to mean revert, whereas stocks tend to go up over time. So, the price of a lot of commodities, if they surge, often the correct move is to fade that surge, and they will go back to their fair value, and trade roughly in with inflation of 2 to 3%, increase every year. Whereas stocks do something like 9% every year, and if a stock goes up, oftentimes you can ride that trend for a long time. And I also will echo something Warren Buffett has said, which is over a 50 to 100-year time horizon, very confident that equities will outperform commodities. Now that being said, Max, my first instinct is, oh my God, silver's gone from $21, a little over $20 to $100. It must be a bubble. It must be a speculative bubble, and I feel like that argument makes sense. And I feel like oftentimes most of that is the truth. However, Max, just looking into who I think is buying and what the supply demand situation is, I don't think that it's that simple, and I really think that this might not be a large speculative bubble that is about to pop. Certainly, I would expect corrections. I think many times on this program been like, oh, I think gold and silver are going to have a correction just because it has to, because it's going up every day. I was wrong about that. Other than I think maybe Diwali in October, an Indian holiday, silver had a very large, sharp correction. Other than that, I think there's actually been very few violent down moves, and even the up moves, they've just been quite somewhat steady. So I'd say the volatility has been lower than I would have thought, given how much it is up.
Yeah, it feels like when it opens up every day, I check. I'm like, oh, is today going to be the big red candle in silver and precious metals? And it's like, nope. Gold's up a little less than 1%. Silver's up somewhere between 2.5 and 5. It feels like clockwork.
Yes, and actually, the great Milton Berg, who I hope we will be getting back on Monetary Matters, he often had the great observation about stocks. He says, I get worried about stocks when the stocks begin to trade like commodities. My observation of silver and gold, particularly silver, is that it's almost trading like a stock, in that it's like a stock in a classic bull market. It's trading like Nvidia was last year. So basically, Max, let's get to the fundamentals. So there was a shortage of 95 million ounces last year. The amount of supply was roughly a billion, and it was demand is 1.1 billion, and that is the fifth year in a row that there's been a supply demand imbalance. Now, as I pointed out in our October interview, a lot of these silver reports, who have a generally pro silver, pro gold bias, they do count people buying coins and bars as including in that demand, which makes sense. So it's not all central banks buying it, or it's being used for industrial case. But silver is used for industrial use cases, particularly in the electrical industries, particularly in solar, and increasingly in AI chips. And this is something I've only discovered like over the past 2 months. So a single digit percentage of silver is used in the creation of AI chips, in particular something called silver sinter paste. So I think there is a bid for silver that is industrial, that is not speculative, that makes me pushes back on my initial reaction, which is this is a bubble and it's always going to pop. That's always my initial thing. Anytime something goes up, is this is a bubble and it's instantly, it's going to pop tomorrow. I think on equities, it's easier to fade that because there are, certain secular trends and the earnings are growing so rapidly. On a commodity, I think my instinct is to say, oh my God, this is going to mean revert because commodities almost always do mean revert. But so the demand is growing. The supply has been shrinking. The supply now is mildly below where it was 10 years ago. And the demand hasn't been growing that much, but the portion of demand that has been growing is going to continue to grow. Solar, AI, electrical use cases, and in particular, again, I'm not an expert in this, but I know that there's a type of this type of solar technology is more silver intensive now than it was 5 years ago, and the industrial companies are just racing to buy as much silver as they possibly can to meet this demand. And a lot, there's a great guy, Alex Campbell, who's super early on silver. Former did commodities at Bridgewater. I actually haven't interviewed him. I would love to interview him. I haven't. But he, in a piece, wrote how actually a lot of some parts of silver can be replaced with copper, some parts can't be in these electrical processes. And that, I think in a solar thing, he said demand destruction didn't begin until $125. So I'd say he's much more of an extreme bull than I am, and uh, I wouldn't even say I'm bullish at 100. I'm just kind of resistant to caution, and I'm looking at ways to make money if silver stays between 70 to $110, which I think there are several ways. I can pause there, Max. I have some observations about the way that it's trading, particularly the margin moves. I would not say I'm an expert trader by any means, but just by studying history, I know that the previous two silver bubbles, which were 1981 and 2012 or 2013, were popped when, 1981 was crazy. There basically were these extremely, nepo babies, rich, these rich sons of a really rich
The Hunt
family,
brothers,
the Hunt
yes.
brothers, yeah, who just bought as much silver as possible and attempted to corner the market, and then did so on the Chicago Mercantile Exchange.
For the football
And
fans out there, the AFC Championship trophy is named after the Hunt brothers.
there we go. And the CME raised the margins and it crashed. And actually, I think the peak in prices was about $50. So inflation adjusted, it was about 150. I'm that is roughly accurate. It's not precise, but it's roughly accurate. So in terms of inflation adjusted prices, we are only 2/3 of the way there to an extreme bubble of 1981. So it's getting a little hot. However, Max, and also the same is true in 2012. CME raised margins and the price collapsed. However, Max, okay, the CME and the Shanghai exchange. So there are three places where physical is traded. The London exchange, the CME exchange, the Shanghai exchange. The CME is actually getting bigger, in commanding bigger market share. I actually interviewed the chief economist of the CME in early December, so Eric Norland. People can check that out. But the CME raised margins on January 13th, so around 10, 12 days ago, and I guess the price corrected a little bit, but that the price was like $85 or $90 then. So the price has gone up, and the Shanghai exchange also raised margins to 20%. And the CME changed margins from a fixed level to a percentage margin. So now the margins are at 9%. So you can still get a decent amount of leverage, like 11 times leverage, but the actual amount of amount of margin you have to post, I think, went from 25,000 to 45,000. So it went from a fixed level to a percentage model. So basically, like the things that pop these bubbles in 1981 and 2012 already happened 10 days ago. Let's say close to 2 weeks ago. So I think that indicates that maybe this is not a giant speculative bubble pushed by Western speculators who are using a ton of margin. I do think that there's a ton of Eastern investors, retail investors who are buying it, but they are buying it in coin and bar form. And the point about coin and bar form is people who buy coin and bars tend to hold on to it for a really long time. And if anything, coin and bar demand is pro cyclical, which means the more it goes up, the more they want it. Uh, and so I think Eastern investors, particularly Indian investors, are huge participants in this market. And actually, there's a report from November that we can flash on screen that shows how just these demand for silver among Indian investors has been very pro-cyclical. And even I think because of the weakness in the rupee, I think that basically a lot of Indian investors didn't even experience a bear market in silver because I think the rupee went down so much, and that's what the chart suggests. I don't
Well,
know if
and
that's true.
we discussed last week how poorly the Indian stock market has performed, especially relative to their other emerging market peers and the United States. So if you're an Indian investor and you have been investing in stocks and you've been watching gold, silver, precious metals, like pretty traditional investments, uh, in India go up, maybe you're continuing to sell your Indian stocks and move into precious metals again, when you're just looking at the options that they have.
Completely, Max. And the final observation that I will share before I get into some potential conclusions uh, is that my read of the data of does not indicate that Western investors, Wall Street investors who are trading ETFs, are large participants in this market at all. I think the inflows into American products and United States of America products are not large at all. Like if you look at SLV, the inflows are positive, but they're just not there, and they look nothing like the precious metal bubble of from 2000 to 2013, bull market. And there's some other charts that indicate in Europe and North America, which includes Canada, that it's slightly higher. But I mean, it doesn't look like these investors are pushing the price of silver around. So I think it's mainly industrial producers and the fact that there's just not enough, and then some Asian investors, which are primarily retail investors, primarily buying coin and bars. I think that's also true about gold. And gold, I think gold is less complex, but I think it's because it's more monetary and almost all monetary. It's harder to understand, whereas industrial like data is completely reported. I think it's silver. The like in India, I read this that there it can be used as collateral for loans, so it can a very minor monetization of silver, as well as the central bank of Russia started buying silver. So that's something that's very speculative. I wouldn't say that that's like this is driving the price, but that's just in the background.
So, Jack, I think the nearly impossible thing to determine in this is what is the peak price of silver going to be? The big question, especially for the way that I know that you like to play this trade, and many people who are not trading futures, obviously you have the SLV ETF, which tracks the spot price of silver. You've got some silver miner ETFs are not as big and liquid as the gold ETFs, or the gold miner ETFs. And the problem with silver is it comes as a byproduct of a lot of other mining. So it's pretty difficult to find pure play miner exposure in the same way you can with gold. So you have chosen mostly to play it through royalty companies. Now, again, even the royalty companies, they're usually somewhat diversified in terms of their exposure too. And so for them, the question is not really what is the peak price from this price spike. The question is is there a new floor? Is this industrial demand going to set a new floor
Hmm.
for silver, and is how much higher is it going to be than the sort of high teens $20 range that we saw before, which people talked about as like being a big breakout range. I mean, I remember $18 silver like doesn't feel so long ago, right? So are we in a world where silver starts to be produced more, which is the way it goes with commodities, right? What is that new floor going to be, and what does that mean for the silver producers and for the royalty companies that get exposure to those revenues of the producers? So I'm sure you have looked at that, especially as you consider how high can the royalty companies that you're invested in go. The one that you talked about specifically in our last talk was Wheaton Precious Metals. I know there's a smaller, more speculative one that you like that we're kind of cautious about just because it is pretty small, pretty speculative. But specifically with Wheaton, what have you been looking at in terms of how much money they can be making at current prices? And even if we settle down into lower prices, below where we are now at $100.
Yeah, so that smaller one, I personally myself in my personal investing got involved with it 2 weeks ago, and it has since returned over 150%. So I will such a small market cap, I will not be talking about any of those stocks, and that's just um, a way that's just a kind of the way that we play ball right now. However, wheat and precious metals, I do feel very comfortable talking about. That's a many multi-billion-dollar company. Max, there are three ways to play gold, three ways to play silver. You can trade the underlying commodity. You can buy mining companies, or you can buy these things called streaming companies. Mining companies have a lot of operating leverage to the underlying commodity. They are, for lack of a better word, much more risky businesses than precious metal than streaming companies. If the price goes down, they could lose a lot of money. Also, if the cost of mining goes up, their profit margins are going to get crushed. Their profit margins already are, if with at $1,500 gold, their profit margins are already quite narrow. A lot of these gold mining investor decks, Max, I have to say, not to be too negative, but they include things like EBITDA margins and free cash flow margins and other types of things, which can be completely legitimate measures. But I think with these businesses, commodity businesses includes oil as well, EBITDA margins is so misleading because there's so much depreciation, and every single day that goes by, you the investments that you've put into the ground are are losing value because you're mining them, and that's just the accounting sense. And so, a precious metal mining company, trading at 7 times earnings, is not necessarily cheap at all. And if it's trading at 3 times EBITDA, it's not necessarily cheap at all. Likewise, I would say a precious metal streaming company trading at 30 times net income, 30 times earnings, I would say is cheap. And this is a type of thing, I grew up value investor, of course, like many people watching. But it's just some companies with 30 or 40 times earnings are cheap, and some companies with 3 or 4 times companies are not cheap. That's just the reality. Precious metal streaming companies, they have a completely different business model. They're basically they're not banks to miners, but they invest in the project, and they don't get equity, they don't get debt. I mean, sometimes they make loans, but they get a royalty. So every 1,000 ounces that come out of the ground of a mine, we get 20 ounces, or every 100 ounces we get 2%. So a 2% net smelter royalty, and we're going to pay 20% of spot price of gold, so like guaranteed 80% profit margin. So these companies, I mean, if the price of silver were to go down 70%, uh, wheat and precious metals, its cash flow would still be extremely positive. It might record some little losses, and so the net income might be negative. But these businesses, I would say, are safer than on a business standpoint, on a cash flow basis, than a lot of businesses that many investors invest in and consider high quality. I mean, I might even consider like Coca-Cola. I mean,
Jack,
Coca-Cola.
I do wanna
Yeah,
stop you for 1 second because you were like, "Oh, these investor decks where they're talking about EBITDA at, $1,500 gold." Well, we're about to hit $5,000 gold.
yeah, yeah, yeah,
If we open up green on Sunday night in the futures
yeah,
market, gold is gonna touch 5,000 most likely.
yeah,
So, these decks that you're talking about, you know, I remember seeing them when gold was at 1,500, and these a lot of times are the more exploratory, not the more mature
mhm,
mining companies where gold is not being produced. So that's the other thing too. Within the gold mining complex, you have people who are exploring for gold, like they have a piece of land that they think has gold on it. You have the ones where it's a proven resource, but it hasn't been developed, and they're likely going to be, if it is going to be monetized in some way, it's going to be being bought out by a major who is then going to put in the work. Very rarely does a non-major gold mining company actually take it fully to production
yeah,
and then start to trade at those multiples. It's much more likely that it's going to get bought out. And then you have the larger gold producing companies, which are actively mining gold and, have profits and revenue. So there's a lot of variation even within those. And largely in periods like this where you have gold going up as much as it has, the most speculative stuff where you don't even really know how much gold is under the ground is what does the best. And so, when we're talking about these decks, it's important to remember what is the price right now, and is this company producing anything?
Max, for our listeners who can't see me, I'm nodding my head so violently, it risks injury to my neck. Max, few times in my life have I heard things that are as true as what you said, and basically, I'll interpret a short explanation of what I said earlier is precious metal streaming companies are much more high quality. They have the quality factor than the precious metal mining companies, which can in some instances be very junky. In the same way, like Visa and MasterCard are way more high quality businesses than banks. But that's like saying, like, from April 2020, when we just had a giant depression for 1 month, and then we're about to have the biggest nominal boom in GDP and consumer spending ever. Like, being long precious metals over the past year has been like being long Visa and MasterCard in April 2020. Of you're just long these, oh, I'll just have my little high quality stocks. Like, really, the thing you wanted to own was just the trashiest CLO equity companies and these subprime lenders and the companies that were about to go bankrupt. Like, you in a bull market, the things that are often not the best companies do the best, and that is true in many instances. But in gold and silver, it particularly can be true just looking at the operating leverage. Because, like, let's say there's a company that was their all-in sustaining cost of for gold was 1,600, and the price of gold is at 1,500. Gold going to 1,500 to 5,000 is so good for them. Like, they went from losing money to just making a lot of money. If Franco Nevada, or a precious metal streaming, or Wheaton Precious Metals, for every price of gold they were buying it at $200 an ounce, they already were printing so much money at $1,600. It's so safe. They just, they their profit margins went up, but they went from 50% to 80%. These other more speculative companies went from profit margins of negative 10% to 30%, and the volume is really high. So I would have made way more money, Max, in this precious metal bull market if I had been long the miners rather than the streamers. However, given my confidence in the business model of the streamers, I was able to have conviction and size it quite largely. So I actually might view like a three times Wheaton Precious Metals position as less risky than a one times silver miner position. But how even might, and I might even say that's true if you have to use leverage for the Wheaton Precious Metals. But I understand that many people would disagree with me, and I would respect that disagreement.
Yeah, it's funny. I mean, you're seeing a lot of people turn towards precious metals that you would never have expected
Like me,
at
Max.
you, but also like somebody who I know you are in the process of booking. The date isn't exactly set, but Carson Block of Muddy Waters, known for short selling at Sohn, they actually announced that they are long and are long Snowline Gold, which is a large gold mining company based in Canada, and they have approximately 8 million ounces of gold. So they're kind of in that middle range, right? Where they're not producing gold, but they have a proven resource and they believe it's going to be bought out. And, they believe at the time that they were talking about it back in November, I think it was trading at like around 2 billion CAD. And they think that the resource was worth approximately, I don't know, 4 billion to 6 billion CAD. Well, gold prices have gone up a lot. And if they continue to go up a lot and these majors, these gold majors are being pressured, hey, how are you going to continue to expand production? Because that's the thing with the majors is they do have this terminal value risk, right? Like, what is the terminal
What
value
do you
of
mean?
a, well, you have to keep acquiring properties.
Mm-mm.
Like
Oh
you
yeah, yeah.
do. It's the same thing as an oil company where it's like, okay, great. Like you have this super profitable moment right now in terms of oil production or gold production, but the whole idea is that this is going to continue, indefinitely. That's where you get high multiples, right? Is that there is going to be indefinite cash flow coming out of it. And so if you are a gold major, you it's funny, like you get when they should be acquiring properties, like when gold is down low, transactions are extremely low, right? They actually are kind of you could argue that they're bad buyers. a lot of these gold majors where they are buying close to the top of the market. So when we're asking ourselves, like, how close are we to the top in this precious metals market? One of the things you can look at are these sort of flashy acquisitions where, that's when, and we talk about it all the time. Like, we led off the episode today talking about gold and silver when the price of gold is close to 5,000, when the price of silver is 100. When you start to see people like us talking about an asset class, that that can mean, now look, back in October we didn't signal the top, but as it continues to happen, it continues to take mind share in the media. That's generally a sign. And then, one of the bigger signs is the board and the executives start to get pressure from shareholders to be making acquisitions, because the market says, look at the price of gold, how come we don't have more resources to produce? And that can often start to mark the top of the cycle. So that's just one example of an interesting gold mine that I wanted to throw out there that's sort of in that middle range. And it's interesting, short sellers, because gold mines have typically been talked about as um, the type of asset where it's like it's a hole in the ground with a liar on top. Well, these
Yeah.
guys special in trying to figure out what are the companies that are essentially a hole in the ground with a liar on top, being activist short sellers and hunting for frauds and fakes. And so their move into precious metals specifically is interesting in that regard. And I not that people can't be wrong, but I doubt that they're just punting on a precious metal stock, as one tends to find if you're, trolling around Twitter looking for exciting gold mine companies.
Yes, I mean, Carson and that research team is great. So I imagine that the rock is very good. So very low cost there. I mean, there
And
are
actually,
companies
one
that
more
have.
quick shout out. They're hiring on their natural resources team to go work with their. So if anybody here is a natural resources analyst and wants to go do deep fundamental research, you should check out their Twitter. They have a job posting right now.
That is very interesting. People should definitely look at that. I think if anyone applies and gets the job, that they would be very lucky, and hopefully the team would be as well. Just an example, Max. I actually have owned this in the past, but I don't own it now. I think I lost money on it, but Jaguar Mining, like a company in Latin America, and they just had all these problems. Like the rain got in the mine, the gold was in the water, it got screwed up. Like it's huge operational thing. Some senior official had to leave, not senior official, but a C-suite guy had to leave. Boom, boom, boom. Like that's one of the best performing gold stocks because it was priced for disaster because it was a disaster. But a lot of disaster can be washed away with the beautiful Windex of $5,000 gold. So yeah,
Yeah,
I think, I mean,
that
Max,
was a Grant's interest rate observer stock, wasn't it?
was it really? I don't know.
I think so. I think Jaguar was in Grants for a while.
Like I said, I don't know. I mean, Max, one thing I'd say roughly my personal portfolio up year to date, as we record on January 23rd, I'm up about 21% this year. And I think a lot of that is due to precious metal streaming beta, but I'm much more so semiconductor beta. We can get into semiconductors. So yeah, I've made two big bets and they've both worked out. I've also made bets in software to a much smaller size. And I think, Max, to one thing that I think works is just like betting on your winners and doubling down on your winners and not doubling down on your losers, or maybe even cutting your losers. Like, one stock that I own that's not working at all is ServiceNow. Everyone thinks it's a disaster. I think it's probably will be fine, but I am much more reticent about being short the momentum factor than I was 3 years ago. 3 years ago, I probably didn't even know what the momentum factor was, but it's just, ServiceNow will I think make it, as will Constellation Software, which I'm not involved with, but I think I could see that going down for a while. So Max, just regards to this, precious metals and particularly silver beta, the I'd say I actually have taken a modest short position in the underlying metal silver, but that is against my Wheaton Precious Metals, my other streamers, which have a modest silver exposure, and another silver play that I won't mention. So if the price of silver goes to $150, I will be down on my silver short, but I would be shocked if I not much more up. But it's just a little bit of a modest hedge. So like I've already got positions on, but like one trade that I basically kind of already have on, but uh, is like being long wheat and precious metals and shorting silver in particular. I kind of like what I'm short actually is AGQ, which is the double levered silver position. So obviously you just size it one size less. And the benefit is that you get to harvest the variance drag over time, which obviously, like a lot of quantitative investors, they all know about this thing, but I don't know if they've.
And depending
Uh,
upon the borrow rate, if their borrow rate is higher than your margin rate, then you get that too.
yes, yes. It's possible that I've spotted the opportunities that only exist because I'm a small account, and if you a $500 million hedge fund, that's it. That's it. But that probably is the case, honestly. But I don't think that in the institutional community that these are. I haven't really encountered that. So yeah, so basically being long 5 or 6 times as much wheat and precious metals as you are short AGQ. So wheat and precious metals, historically the beta to silver is zero point 0.8. It's varied a lot. It's actually gone down over time because it used to be a close to 100% silver exposure, whereas now they diversified into gold. Their actual silver ounces produced or silver ounces delivered is actually modestly down over time, but I just think that speaks to the shortage of silver properties. There really are very few silver only properties that can, if you're a big company like Wheaton Precious Metals, you can do big deals with. And so Wheaton is relatively diversified in its silver products. Interestingly, one risk of so Wheaton is roughly like uh, it's a slightly higher percentage of gold than silver, and then the rest is 1%. So it's 99% precious metals. But one risk of wheat and precious metals is it's very concentrated in gold. Of its gold positions, it's very concentrated in this one mine called Salobo, which has been just a phenomenal deal for them. But if that country decides to just take away the mine like they did to Franco Nevada in Panama, which was a serious risk, which I've also been invested in, that would be a big problem. But yeah, wheat and precious metals, it also has exposure to gold, and yeah, I guess I've sometimes the precious metal streaming companies have been referred to negatively as the coward's way out. Uh, Basically, they're a pansy way to bet on silver and gold, and I'll take that criticism. I think the miners have done a lot better, but I think yeah, I think that these companies are very high quality companies, and based at 100 times silver, net income, so after tax everything, Wheaton's roughly like 23 to 25 times net income, which would, again, if the price stayed at 100, that would be a historically quite a cheap valuation for a company that has profit margins higher than Visa and Mastercard. So Max, I referenced semiconductors earlier. I want to talk about the semi complex. Intel reported the stock down massively. You've been doing some work on this. Want to get your take on it, but first, want to shout out our sponsor, Fiscal AI. Max, it's where we get all of our fundamental equity data, where we do our research, and the charts that our audience can see today, they're all from Fiscal. And with the link in the description, you can get 15% off any paid tier, including their max tier, which has downloadable data. And by the way, they just slashed down prices by over 50% to $800 a year. They're making big pushes with their data API business. So if you want that seamless API capability, contact their sales team. Let's get back into it. Max, tell us about Intel. What happened there?
Yeah, Intel is very interesting. It was considered to be an AI loser for a long time, pretty much until it captured the eye of the Trump administration, and then the U.S. government took I believe, a 10% stake in the company. Since then, the performance of Intel has been pretty great, and it has been viewed as a potential AI winner, but with a Trump halo effect that has pretty much gone to just about any stock that the administration has taken a stake in or shown an interest in. And up to this point, it's performed phenomenally well. Before earnings were released, as of Thursday night, it was up 44% year to date. A lot of dispersion right now in the semiconductor space and the sort of AI related name space. So, it's interesting that Broadcom, Nvidia, some of the big winners of 2025 are actually down on the year, whereas there are plenty of the larger names that are up. But it's really broadened out to much of the smaller names. But Intel was one of the names that had just done phenomenally well year to date, up 44%. And earnings came out and they beat across the board on the major stuff. But Wall Street didn't really care because they kind of gave soft guidance. And in particular, one of the issues that they had was that they just haven't been able to meet demand for the chips. So they're not able to ramp up production, which was basically the bet that a lot of people were making, is that Intel is going to take on this investment from the U.S. government. It's going to become the American powerhouse of semiconductor production, and they just haven't been able to ramp production. So if they're going to become the powerhouse of American semiconductor production, they need to be able to do that, and they're not. They're not right now ramping production. And so if you just look at the headlines of Intel beats, you would be surprised. And I think it's important because whenever you have a big semi name report and you're trying to understand the market's reaction to earnings, you might think, oh, was there some big hit to demand that might play through to other semiconductor names? And that's not really what it is here. It's pretty idiosyncratic to Intel's inability to meet the demand. So that is the big thing there. But even if they were able to meet demand, Jack, one of the things that you pointed out while we were getting ready for this was their foundry operating income and just how bad it is that this thing that is supposed to be the future of Intel, they don't make money there. They didn't make money last quarter. They've never really made money. If you compare it to Taiwan Semiconductor for the same basic business line, like, it's pretty stark just how unprofitable this is for Intel. So, there was hope. It was a hope story. It was a Trump story. And at least after, Q4's results, it appears that is still just a story. And so with that being said, the stock is still up after being down, I think, like 17% today. It's still up over 20% on the year. So, still very strong if you've had it in your portfolio. But if you bought it as an earnings play, you are definitely hurting. So I think that is something that people should be focused on. And if you were viewing the sell-off today as a signal that the AI trade is done, I think that's probably not the way to view it. But it is a signal that people want to see results. So that eventually there is a breaking point on the narrative front, and that investors at this point in time, if you are spinning a story of benefiting from the AI capex trend, that eventually people do want to see it come through. And that's the thing with the Nvidias of the world and some of the other stocks that performed well in 2025. We were seeing it come through in the earnings. They kept raising guidance, and Intel came out with actually guidance that was below expectations.
I mean, the revenue was down year over year, even though that beat expectations. They're a legacy company that at a time was very dominant. Their chip business right now, they have a lot of legacy chips. They have a foundry business. To the extent that they have, true cutting edge technology, a lot of it is in this thing called advanced packaging, which is not the chip itself, but connecting the chip within an architecture and basically, making it building a beautiful puzzle of all these chips together, and how they can work together in the same way like the heart and the brain, and the liver work together, and I think that they're making huge investments in their foundry, but the yields are low. So that basically means like a lot of the chips that they make are faulty, and TSMC, I don't know what the yields are, but Taiwan Semi in Taiwan, like the yields are high, meaning that a lot of the chips that they make work, and so that because of that, it's very profitable. But if a ton of the chips that you make you got to throw in the garbage bin, that's very profitable, unprofitable, and that's why I think the foundry business has been losing so much money. I know a lot of very sophisticated investors were quite bullish on Intel because of this advanced packaging thing, and that maybe Intel's technology could be as good or maybe even as better than TSMC, which is unheard of in this modern day, particularly in this advanced packaging sort of chiplet thing. But I think that the technology is good, but the implementation, as you said, is not there, is not there yet. But I think, Max, I mean, a key point you said, which I agree with, is that demand is not an issue. I think across the entire semiconductor complex, demand is just astronomically high. I think like memory prices are up 10x. So that's why, I mean, literally SK Hynix, like one stock, as well as Samsung, is why the South Korea stocks are doing, South Korean index is doing so well. I mean, there are other South Korean stocks that are doing well, don't get me wrong, but it's just absolutely crushing it. And I think that we are in a huge industrial revolution of building out AI, what Jensen Huang and the semiconductor, AI lovers call AI factories, and that CEOs and politicians, leaders around the world are trying to make this happen. And I think there are a lot of people who are naysaying it because they don't like it, because they think it's a bubble, because they're worried, perhaps rationally, that is going to uh, lead to a fall in jobs and a collapse in employment and a surge in unemployment, which I think would be a horrible thing. Um, but the reality is that the people who are spending the money and who have the power, they're pretty united on this vision, and it is so extreme that it is causing huge supply squeezes in not just in memory, but all sorts of electrical components. I mean, I mentioned silver. I think that is a relatively small part of it, but silver, copper, natural gas. You interviewed Michael Cow, who AI is going to use all this electricity, and I always weigh the right tail risk and the left tail risk, and the left tail risk is it's a giant bubble. The right tail risk is asset prices are very richly rewarded. However, there's could be very negative consequences for unemployment, which I think would be very 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 negative. But I also think that like it's possible, profit margins up, uh, unemployment up. That is a possibility, and I don't know exactly how I'm assessing the probability of that versus like a kind of a vanilla recession or a vanilla bubble imploding. But I'm looking at the right tail as well as the left tail.
Yeah, Jack, I think the memory thing that you pointed out is also one of the things that weighed on Intel. So much of their revenue and profit comes from their traditional chip business that goes into PCs, and there is concern that with the price of memory going up, that's going to weigh on PC demand. So if you are, a purchasing manager in the IT department of a big company and you're looking at, wow, look at how much it's going to cost us to upgrade everybody's laptop this year, you might say, "Oh, we'll wait a year to go buy those laptops," and so that's going to hurt Intel. So there are the winners that you're talking about in the memory space, and Intel is, at least at this point in time, being perceived as a potential loser in the memory space.
It's good, and I think Max, it's a concept is like if memory is a cost to companies, how much does it matter? Max, you and I know some very sophisticated, very good performing investors who are very interested in Nintendo, and they might make the case that okay, Nintendo memory is a cost to them, but like it's a tiny fraction. That is the argument. Likewise for silver, like all these, why are these why are these solar companies? Why are they not mad about silver? It's like it's a tiny percentage of their cost. So a 10x surge in a 10 basis point product as a cost is what hurts you way less than a 2x surge in something that's 20% of your cost.
Yeah, and that was something that I first started to think about during one of the big price spikes in uranium, because we were talking about these nuclear power plants, and it was one of those things where it's like, well, isn't there a point where they're not going to turn the power plant on? And why aren't these fuel buyers, why aren't they rushing to buy more uranium as the price is going up? And people in the industry astutely pointed out that when it comes to the cost of operating a nuclear power plant, that the cost of uranium just is such a small fraction compared to all of the other stuff that goes into keeping the power plant running, that they the price can double and they just don't care because it doesn't really impact the margins that much.
And I'll say, in case of uranium, obviously huge bull market, but that price is down from its peak of several years ago. So commodities do tend to mean revert, and I'm not saying $80 silver correction or $30 silver correction. Like what do I know? I'm resisting the urge to say this is a bubble and it's going to correct, while also pointing out, as I've said several times, that commodities are mean reverting.
Well, there's one commodity that has put silver to shame this year, and that is natural gas. So, we talked about the interview I did with Michael Cow and the sort of long-term bullish demand case for natural gas, specifically due to a couple of things: electrification, but just in general, electrification outside of AI. Then there's the AI demand and the sort of off-grid demand that could come from people generating their own power by burning natural gas, at the actual data centers themselves. And then just the global demand and the fact that as of right now, we don't really have a global market for natural gas. It's very regionalized, and we just don't we don't really have that. And so that's the long-term thesis. And so a lot of times people, when they hear about these commodity theses, like silver is one, uranium, natural gas, it's very easy to get excited when you start to hear these narratives and the price responds and attribute what's happening in price right now to this longer term trend. Copper is another example where this kind of got a head fake before. And so natural gas in particular is known as like the widowmaker. It's one of those must be this tall to ride the ride things when you're trading, especially the futures. In the past 10 days, natural gas is up 70%. So it went down to $3.10, back up to $5. That's after touching $5 back in December. So this is the type of volatility you can expect with natural gas. And so if you are somebody who is saying, I'm really bullish on natural gas because of a long-term view and you're seeing this type of price spike, you really have to be cautious because what's driving it is the storm of the century, which is hitting the East Coast and the drop in temperatures that we're seeing across the United States. And it is really related to the United States because again, it is a what Michael Cow was calling it's a landlocked commodity. And it's even we even have different pricing in different regions of the United States for natural gas based off of what infrastructure there is for transporting it around. We talk about the performance of these energy stocks tied to natural gas. We talked about, as you said, the broadening of the uh, AI bull market to some of these smaller companies that are further down in the supply chain. And that's really played through into the Russell 2000 more broadly. So, talking about performance of indices year to date, we did a sort of year in review where we looked at what worked, what didn't. Last year, the Nasdaq beat the S&P 500, which beat the Russell 2000. We had strong outperformance from the rest of the world. Some of those trends have continued into 2026. Some of them have not. And one that has not continued has been the outperformance of large caps. The rally has really broadened out. The bull market has broadened out into the small cap space, and the Russell took it on the chin today because of sell-offs in largely from the bank sector. There was weakness in a lot of small caps, but really the banks, which have a big influence on the Russell 2000, had a pretty bad day, despite being down around 1.8% today, while the S&P was essentially flat. The Russell 2000 is up over 7% year to date, whereas the S&P is hovering between 1 and 2%, and the NASDAQ is as well. Interestingly, emerging markets are similarly up around 7.5%. So the outperformance ex-US has continued. But small caps, at least here in the United States, have taken over, and that's due to a broadening out to other sectors and then moving down within the technology sector, a broadening out to smaller cap companies. So it's one of those things where when you see the S&P 500 being up a lot, it's very easy to say, oh, well, that's just driven by a couple of stocks. The Russell 2000 is not nearly as overweight its largest components. And so, when looking at what's working in the Russell 2000, it's pretty much everything. Jack, I know you looked at some data. What is the breadth like within the Russell 2000 and what are the sectors that are driving it higher?
It's a lot of natural resources. It's a lot of banks. It's a lot of materials. So, Max, interestingly, even though the financial sector in the US is not doing very well year to date, perhaps because of credit card threats of 10% cap, perhaps because of the Credit Card Competition Act threats as well from the President Trump, which we covered in our previous interview. Even though the US financial sector has not done that well. And even though the regional banking ETF has not done very well, which is dominated by like large regional banks like Pinnacle or Fifth Third, even though that is also not doing well, the financial companies that are in the Russell 2000 are so small that they actually are doing really well. So there are some like sub-regional banks, like way smaller than PMC, that are actually doing really, really well for reasons that I don't understand, to be honest. And I think also, Max, that the natural resources is done really well. So, no surprise that the gold miners, the copper miners, some natural gas companies are doing quite well. And, calculated that roughly 8% of the total index gains year to date are from natural resources, 4% from materials. So companies like Steel Dynamics, Tetra Technologies, a lot of onshoring themes. So companies like Sterling Infrastructure, Granite Construction. So basically, this would be categorized as industrials. Some defense sectors. So I don't know the defense sector as well, but basically the materials, so that's natural resources, so as well as minerals, is a higher percentage in the Russell than it is in the S&P. So the S&P is quite underweight um, these material companies. um, I know the great investor Murray Stahl from Horizon Kinetics. This is like 5 years ago, so it's 5 years out of date. But there was a time when there was precisely one company that did gold mining in the S&P 500, and I think it was Barrick Gold, which has since uh, uh, renamed itself Barrick, because it's like, oh, we don't need to do gold mining, and then of course gold goes up so much. Yeah, I think modestly, like if these natural resources do well, that should benefit the Russell over the S&P. However, it's not a big driver. And as you pointed out, Max, there's 2,000 companies in this index, so it's quite hard to look at any single one. But it is interesting that it's outperformed. You didn't ask my opinion, Max, but I'll share it that I'm a little bit skeptical of this. You look at some of the companies that have been kind of dumped into the market. A lot of these companies are small cap companies because they used to be mid cap companies, or because they were small cap. They've been small cap companies for a while, and they're almost by definition their 10-year or 20-year performance is a lot on average. Tends to be quite lower than the S&P type companies. So I do believe in. I'm kind of reinventing my philosophy, Max. I believe in trends. Winners keep on winning. Losers keep on losing. And sure, the Russell could do great. It could crush the S&P this year. It could crush it next year. But I generally would stay away from a like sector overweight, and particularly, Max, on the view that it's a small cap. Like actually, if you look at probably my portfolio, like I have tons of small caps, but I like them for specific reasons. I don't like them because they're small caps. So I think that the a way of a lot of allocators think is like, oh, what's my small cap exposure? What's my mid cap exposure? Warren Buffett has spoken quite negatively about that outlook, and I generally would agree with him. XYZ type company, like a Pathward Financial, which is actually a banking company that was up, I spoke about last week, and it was up today on quite good earnings. That I guess is a small cap, perhaps type company, but like I'm not bullish on it because I'm long the small cap factor. I don't even know if the small cap factor is a real thing. It was when all the nerds did the math in the 1980s and 1990s, but small cap premium has been negative for many years now.
The
Yeah,
profitability is way down. And that's one of the things you talked about, the nerds doing the math on small caps and why that has changed. And one of the things that I think AQR in particular has looked at with the small cap factor is, well, if you adjust for profitability, if you adjust for quality, is there still
yeah.
outperformance from small caps? And they found that the answer to that is yes.
We kind of agree. I'm saying like, yeah, be long the adjust for be long profitable companies, be long companies that do well. And also, founder of AQR on Bloomberg last year in an interview, he talked about this. He how he loves trend investing, and he also loves economic trends. So basically, if the price of Apple keeps on going up and up and up, like that's a bullish trend thing. But also, if the revenue keeps on going up and up and up, that's likely to continue. So trends are real, and if if you have people who have good days on Mondays and Tuesdays are more likely to have good days on Wednesdays than people who had bad days on Mondays and Tuesdays. And often investor psychology, at least I think a lot of beginner investor psychology, definitely myself, beginner investor psychology, is to not believe that and think, oh my God, this stock has been down on Monday and Tuesday, so it must have a great Wednesday. And often that is just not the case.
I was looking at the natural gas complex, and to do that, I looked at our friend Citrini's basket of natural gas that he put together for the first time, I think, back at the end of 2024. Getting forward to 2025, put together this natural gas basket if you want to get exposure to natural gas, which can be tough because it is often produced similar to silver as a byproduct of fracking and oil. So if you want to get that direct natural gas exposure, it's often very tough to do in terms of a production company. And that's part of the reason in the interview with Michael Cow, he talked about natural gas mineral rights. And that's why he's playing it via more of a private portfolio, because it is just so hard to get that public exposure. We already discussed why trading natural gas futures is so difficult. So it is really one of those trends that is super hard to get exposure to. And if you look through the companies that he had in his basket, which the composition of does change over time. He adds and removes things. Um, a lot of them are services companies. They're not producing. They're doing something in the supply chain of natural gas. And obviously, when the price is high, business is booming and they're doing well. So when I looked at the basket and I just sorted by year to date performance, funny enough, a lot of the stocks that were the top performers, the top three were all inactive um, in the basket. Two of those, the number 2 and 3, you could argue it looks like they were probably sold as winners, and Citrini took his profits and moved on. But the top performing one, which was up 52% year to date, was the stock New Fortress Energy (NFE). And when I pulled it up on Fiscal, it was hilarious because I was like, wow, it has a market cap below 500 million, but it has a $9 billion enterprise value. So that just means it's like a super levered, indebted company. So oftentimes when you have big performance from the Russell, big performance in the commodity sector, or these names are viewed as beta to some other underlying asset, you can get really the worst of the worst companies sort of outperforming. And there are great companies that when the times are good, they don't mean revert. And then there are companies like NFE that I think at some time this year, we're probably going to see it lower than where it is today, despite the strong year to date performance. So something for everybody who is chasing these higher prices in commodities should keep in mind. Is this a quality company? Is this a company that is a winner over time or a loser?
You're completely right about that huge ballooning debt figure. Apparently, like, so it's recorded as current debt, so due within the next 12 months. Which, if it was true, that would be a just total disaster and bankruptcy in counting and debt countdown. But apparently, because they missed interest payments and violated covenants, accounting rules require them to classify long-term bonds as short-term debts. So technically, they actually don't owe that money all immediately, and apparently they may have like avoided a liquidity crisis. So that's probably why the stock goes up. Like, if the stock is priced to go bankrupt and then the market decides that they're not going to go bankrupt, that is typically very, very good for the price of that stock. I will say, Max. So yeah, I mean, a lot of those names are in the pipelines, in the supplying natural gas to the data centers. And I mean, obviously, I don't know if it's in the index, but like the best performing stock, one of the best performing stocks of last year was like GE Vernova, Siemens, all these companies that have natural gas turbines that basically produce electricity for the data centers. And legendary investor Chris Hone, who had the most profitable year in dollar terms for a hedge fund ever, I believe, last year. He was a big investor in GE Vernova. And I mean, so many noob investors like me, Max, like GE. I mean, GE is a piece of crap. Everyone knows that, like, that company's been ruined and there's nothing valuable there. But I was wrong, and Chris Hone was right. There was a huge shortage in natural gas turbines. But I will say, Max, a lot of natural gas names to me are just, I mean, literally, it is a commodity. And also, I mean, so you got Michael Cow being bull on natural gas. You got Trini being bull on natural gas. A lot of smart people being bullish on natural gas. I'm not disagreeing with them. I will say that, how people say about silver, it's going to take years for supply to come online. That is true about silver. It is not true about natural gas. Like, natural gas is the type of thing you just, like, basically stick a large metal rod in the earth and then the natural gas comes out. So
Well, which is why the infrastructure plays are interesting, because the idea is that if we're going to be burning more natural gas, which if you look at the share of energy production that has come from natural gas, it is growing and it's projected to continue to grow specifically for AI demand. What we need to do is build out the infrastructure for all of these places. The hard part is not getting more natural gas necessarily. It's getting the natural gas where it needs to go, and then actually turning that into energy, which is what a lot of the companies in that, that give you exposure to natural gas do. But the other thing is, as we said, it's a byproduct. So you say, yeah, you just stick a thing in the ground. Well, what happens if we do unleash Venezuela and all of the oil from Venezuela starts to come to us, and the price goes down? Like, Trump wants gas prices lower. He wants to
Mhm.
be perceived as having whipped inflation, and that's oil prices. Well, the interesting thing is that if oil prices fall and shale production becomes unprofitable, you it gets shut down. Well, that means that natural gas that you're saying is a byproduct that just spits out of the ground, well, it's not coming out. So an interesting thing is that the negative trend in oil prices could actually be very bullish for natural gas prices.
That makes sense to me. I don't have a strong view on natural gas prices or really oil prices. However, here is my strong view that a lot of people are going to create these fancy little allocations to natural gas in order to express this view. But that me owning Texas Pacific Land Trust, I'm going to outperform them. That's a high conviction view. I just Texas Pacific Land Trust. They produce a lot of oil. They produce a lot of natural gas. Interestingly, a lot of their pricing of the realized price for natural gas has actually been severely below the market price because there's a lack of pipeline infrastructure out in the Permian Basin in some regions, and I think it's called the Waha Hub. I believe there's a plan to build out this pipeline infrastructure so that a lot of the natural gas that Texas Pacific Land Trust is producing, they're going to be able to get credit for. And by the way, Texas Pacific Land Trust, they do not drill. All they do is own land. It's a royalty play, and
Oh,
they
yeah,
also
you love your
they
royalties.
I mean, so I love companies that have 70% margins. I mean, what are you going to do? And they have a they've winners keep on winning. They're up like a gajillion percent over the past 20 years. Whereas a lot of these natural gas companies that everyone loves are trading at the same price or maybe even below where they were 20 years ago. The Michael Cow deal sounds interesting. I can't get involved with it with that deal. So I've got Pacific Land Trust, and I think it's going to treat me quite well.
And to your
I
TPL, Jack, when I did the sorting of the Citrini natural gas portfolio, it pops up. It's in the top 4 in terms of year-to-date performance of the active names. And there are some of those more diversified, like less pure exposure plays, because it is just so hard to get the pure exposure. And
Right,
in
and TPL, like oftentimes I think a lot of index inclusion thing is a little bit overrated. And like obviously passive investing is extremely real and very relevant, but in order to express how that's impacting prices, I would say it's quite difficult. But I TPL was included in the S&P 500. Uh, and when it did so, it had a huge spike. So I'm sure a lot of the pod shops who specialize in index arbitrage made a lot of money there. But TPL was extremely overvalued, and since then the price is down about 50%. So I think its valuation is quite good, and certainly the president is in favor of drilling.
All right. Well, let's close it out, Jack. There's one thing that the president is also in favor of, and that is cutting interest rates. We have a Fed day next week. What do we have to look forward to?
As we sit here today, the news across the tape is that leading fixed income investor at BlackRock, Rick Reeder, is looking quite favorable to the administration. I mean, he certainly knows his stuff. He knows the duration. He knows the convexity. I think who cares what I think, but I think he's qualified. He gets my stamp of approval if anyone at the White House is listening. And that I think President Trump, he does like very smart people from Wall Street. Everyone said the president is so anti establishment. He would never pick Scott Bessent. He worked for George Soros. I mean, doesn't he know George Soros is donating to all these left wing causes? But I mean, Scott Bessent, extremely talented and smart financier who's now the Treasury Secretary. So I think the president, he likes very smart people to be in the role. And I'm biased because I know him, but I think the person he chose for the Fed governor, Stephen Myron, is very smart and talented as well. So that impacts things. I mean, I think that next Wednesday, the Fed meeting is going to be the last meeting where Fed Governor Myron is going to be voting. In December, I would have known that to be true. However, I was hearing rumblings that maybe his term could be extended. A lot is up in the air. I will say, Max, that I actually asked veteran macro investor Andy Constant about this, and he actually said no to this. But I might disagree. Like I asked Andy, to what degree is gold and to a less degree silver rallying because the president is getting quite active with regards to the Federal Reserve. And in his own words, the president's own words, he says, "I think I should have a say." Whereas, for 3 decades, we've had this thing called central bank independence, where the president should not have a say. At least in several Western countries, there's some exceptions where uh, they don't have central bank independence. But I wonder if gold is rallying so much because the president is getting involved. I think also gold is rallying because geopolitical uncertainty, which generally is a thing to fade. Like, I think that geopolitical uncertainty uh, often resolves itself. Um, Mark Carney, the head of Canada, gave a speech where he basically said that the Western order is rupturing, and that we should, basically the rest of the world should coordinate to uh, around the U.S. So that's probably not great for the dollar. I think that we had Max last year. We had this scare of, oh my god, and I was part of the scare. I believe the scare, so I'm guilty, But that this scare of, because of tariffs, the rest of the world is going to dump their U.S. assets, and that didn't really happen. We now have the data. We know that didn't happen. All that happened is they continued to invest in the U.S. They just increased their hedge ratios. It was marginally more favorable to hedge out of the U.S. dollar, and they did so. So the U.S. dollar weakened, and the rest of the world outperformed, but also the rest of the world's currency mostly outperformed as well. If you factor in carry and as well. I think that because of that, it might be our instinct to fade that as well and say, oh my god, no one's ever going to sell the dollar. No one's ever going. But like, it these the administration is pushing for some big changes in Venezuela, in Greenland, and I'm not saying that it's going to lead to a meaningful shift in asset allocation, but I'm not putting that off the table at all. And I would say that I think with regards to precious metals, that maybe the president getting involved with the Fed is leading that. I mean, Max, we're in a world where it's kind of been normalized that the president is doing that. I
Well,
mean,
Jack,
what?
I just checked FedWatch just to be certain of this, but it's 97% chance that we're not going to have a cut.
Yeah.
And that means, and I would put that as, we're going to have a 97% chance of a Truth Social post about the decision to not cut. And we're going to get to see what gold does within, a few seconds and minutes of that Truth Social post going out. So if you want to get an idea of whether gold prices are moving based off of what President Trump thinks about the interest rate decisions of the Federal Reserve, we're going to get, N of one, but we are going to get a data point next week. So that is something that I am closely going to be watching, is how does Trump react to the lack of cuts that I think are almost certain to happen, and then how do asset prices react then to that post.
Yeah, Max, it wasn't until I did the interview with Andy that he drew attention that there aren't that many rate cuts priced in. I mean, we have all this pressure on the president. From the president, he's going to choose the next Fed chair. Boom, boom, boom. I would have thought that like the terminal rate would be 2%, but really it's only pricing like 30, 40 basis points roughly of cuts. So Andy made a bull call on interest rates that the Fed's going to cut more than is priced in, and therefore it's good to be long short-term interest rates. I'm inclined to agree with Andy. I'll just leave people with this thing that I think, Max, you and I, we are macro people. That's our background doing interviews, but we really, really respect the micro, and we respect that, value creation happens at the company level, to quote my guest, Dan Kraus from November, and that value creation, happens on the individual decision, and that it's easy to go full macro and never go full macro and totally miss the giant trade. Like, if for there's some reason to be bearish and you miss the giant move in technology and semiconductor stocks, like, don't that was a mistake. Like, don't do that. I do think macro investors, Max, are generally too inclined to be overly bullish about precious metals and overly bearish on equities, particularly U.S. equities. So I just think that that I just want to leave that with there. And I don't know. I think these semiconductor companies, and I mean Google, all these a lot of companies that with connection to AI, I think they could do pretty well as we enter into Q1. What do I know? Just some podcaster, but that's what I know. And I also think I want to leave people with this. That I looked up Visa, the stock, right before this, and a report from Nasdaq. The question was, thinking of buying Visa before Q1 earnings, you might want to wait. And like obviously that was written by an AI or whatever, but I want to, my shout out my dad. He talked to me about how like in 20 many years ago, like 10 plus years ago, maybe even in 2010 or even before that, there was a sell side analyst that had a report about MasterCard, very similar business to Visa. And the report was like, MasterCard is dead money. And that, a macro analyst would have written that. Like sell side analysts are also often also, a little too skeptical on long term winners. So if you look at the price of MasterCard, it definitely wasn't dead money. And I think that I still think there's value to be had in longs in this market, but maybe I've just drank the Kool Aid. Also, Max, I'll leave it there. We did some work on some like random semiconductors that we've never heard of. It's like what type of company are you? And that are up a ton. I will just leave this. No, I do not own this, but it is a competitor to Broadcom, MediaTek. There's is a competitor to Broadcom, so it's in the custom ASICs, helping giant companies that produce their own chips rather than just buying the NVIDIA chip. Google's been a customer of Broadcom, probably is going to continue, but if there's a little bit of competition, MediaTek might benefit in their business. So again, no position, but just throwing that there. Thank you everyone for watching. Please leave a rating and review, and don't forget to check out our sponsor for today, Fiscal. You can get a 15% off going to fiscal.ai/mm. Until next time.